to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the guy we named the show after, the master, the guru, the head honcho, AJ Brown. Good morning, AJ.
Hey, look, I'm all nice and cozy. We've had a cold snap here on the East Coast, so I had to put on my nice warm boyfriend cardigan.
Yeah, cold here too. Hit about 65 yesterday on the high, freezing my butt off. Had to put some long sleeves on.
Oh,
episode-
hold on one
we
second.
got a special guest.
We've got a special guest who just walked into the show. I
Making
don't
her
know if
debut.
I don't know if mommy knows that Josephina's in on the TV show, but maybe she'll come around the corner as well. That's funny.
Well, we'll get her. We'll get her on soon enough when we get to the vertical spread section. Maybe she could come give us the breakdown.
Absolutely. Here comes mommy.
Episode 109. Today is December 1st, the first day of the last quarter of the year.
It happens. We are live.
Always, every Friday. And so AJ, I woke up this morning and I saw the market up about 100 points, and just last week the market continued to rally, and I was very surprised that we're maintaining these levels. That was the first thing that came to my mind. What are you seeing? What is top of mind for you this week? I know there's a lot of economic news. Where do you think we should begin things?
I mean, it's all about sentiment, right? And I've been doing this a long time, and this is the first time that I've seen such a breakdown between data and perception, right? And don't get me wrong. So data typically pulls out the volatile readings of things. So volatile readings of expenses in our lives, food, energy. What do we spend the most money on? Food and gas at the gas pump. So that's where a lot of our sentiment comes from. But there's also just an overall feeling in the air that things aren't well. But when you look at the data, I mean, things are better than they have been in decades. So there's this weird, like just disjunct, and that's also not just driving like people's sentiment out in Main Street, but on Wall Street, investor sentiment is also, there's perception and then there's reality. And I don't feel for the Federal Reserve, right? Because the Federal Reserve pulls the levers. They've got here in the States, which is different than any other central bank. They have a dual mandate, so maximize employment and control inflation. Most central banks in the world, their only mandate is to control inflation. So sometimes those are at odds with each other. But I listened to an interview with the Chicago Fed this week, and basically, to sum it all up, they're very much data driven, and they're very much glad that they meet every 6 weeks because they can't prognosticate or forecast anything. But one thing he did say that was very interesting is the Chicago Fed, just in case anybody's keeps track of it. He was a apprentice of Paul Volcker, who was the Fed chairman back when I was a kid, and had to deal with inflation in the double digits, right? A lot of people don't remember that, but there was a time when, the interest rates were up at 14%. And his whole thing was that Paul Volcker once told him that, taking care of monetary policy is like cooking a turkey. And this is kind of, people are cooking holiday turkeys. They did for Thanksgiving. I know that people are putting turkeys on their menu for the winter holidays. You think about it, A good turkey, you take it out of the oven, but it still cooks within itself for some time, and if you leave it in the oven for the full time, you get this dry ass turkey that nobody wants to eat. So you actually have to take the turkey out of the oven and let it cook on the counter for a little bit more so that it doesn't become crappy. Well, that's what the Fed needs to do at this point, really. They need to let the cooking stop. So they did a whole bunch of cooking by raising rates incredibly at the beginning of this year and at the end of 2022. Basically, now they've got the turkey out and they're watching to see if it turns out to be a juicy or a dry turkey. And so people are always, one Fed president might say, "Hey, I'm ready to vote for lowering interest rates." Another Fed president this week quickly said, "Oh no, I'm ready to be diligent and raise interest rates." The market doesn't know what to believe when it comes to that rhetoric, and so we just have to go based on, the measurement of quantitative analysis, right? And so I've actually got a chart up. Do you want to take a look at that chart? Yeah. I mean, here's the S&P 500, and it's been on this expansion phase, and this expansion phase has definitely been in the upward direction, but this doesn't make an upward trending market, right? This one move that started back on October 27th, so it's been about a month now. This one move does not make an up market, right? In fact, we know from looking at NASDAQ level 4 data that at 4,600, there is so much selling pressure that any price action, in fact, it's already started to kick in. And when you have selling pressure, prices start to drop, right? When people start selling things and there becomes this is economics 101. When people start selling things and supply starts increasing, prices drop. So this selling that we expect at 4,600, it's already kicked in, has pretty much brought to an end this uptrend, or this not uptrend, but this up move that's been happening. We haven't got a confirmation that a top has been found, but you can see that we've been stalling for about a week and a half now, and it would be really a feat. Like, there's so little probability that we can get over that 4,600 right now. The more likely thing that we're watching for is that a reversal to be called and then a pullback. And what's really critical is measuring where that pullback lands, right? If that pullback lands in about the halfway mark of this previous, then that'll say one thing. If it overshoots it, that'll say another thing. If it overshoots this whole move that it just is completing now, that'll say a third thing. So we're not ready to actually call this market anything more than in transition until we see where the next reversal to reversal, top reversal to bottom reversal goes. In the meantime, we have to stay very short-sighted in our trades. Be ready to take profit early, set up the trades so that we take that profit early, and set up the trades for more early profits versus trying to have a trade that lasts long, because we don't know what's going to happen 2 weeks, 3 weeks from now. The market isn't mature enough to tell us yet.
Yeah, and in one of your notes this morning, you said it's a horrible market for long-term buyers, holders, and
Absolutely.
investors. A fantastic market for options traders, which is what your program, what the
Mhm.
trading trainer community, what our show is really all about. And looking at this chart over the last, I don't know, month or so, uh, there may be some good options opportunities. So if you've never sold options or used options to take advantage of a pullback, now's a great time. And we're going to go ahead and provide you with some tools to help you guide you along that process. But before we go into some more examples and your pick of the week, our speed round, I do want to cover some of the economic news, right? Because I think we got a lot of it this week. And the one
Mhm.
that really stood out to me that I think may be a bit overstated is the GDP, right?
Mm.
Because all the news cycles were like, oh, the economy is growing, what recession, da 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 da.
Mm,
And I'm curious if that's really the case or not.
yeah. Well, drilling into the GDP numbers, first of all, remember that the GDP numbers are reported 3 times. So they're first reported, and it's called the advanced release of the GDP numbers. Then they come back a month later and they revise that, and they call that the preliminary release. And then they come back again and they revise it a third time, and they call that the final release. And these are GDP numbers. So we got the advanced release last month. We're getting the preliminary release this month, and this is for quarter 3, right? So this is for ending in October, or actually ending at the end of September, beginning of October. So this is old news, really. And so, yeah, the preliminary numbers came back revised a couple of decimal points higher, right? 5.2% versus 4.9%. But that is, that is something that happened in July, August, September, right? What is actually interesting is on the same day that the GDP numbers were revised, we also got our beige book, right? And I'm not sure if folks know what this beige book is, but 2 weeks before the Fed meets, a whole bunch of data is correlated, and this is the main data that the Fed looks at when they meet, right? Along with all the other economic reports. And of course, this is public information and it's quite boring. But if you really sift through this time's beige book, what you'll realize is the more current data shows that businesses are slowing quite exponentially, right? In quarter 4, businesses are slowing down. So whether GDP is good if you're looking in the rear view mirror, or if you're kind of looking in the present, things are slowing down. It all comes down to kind of how you want to interpret that. It's worth also mentioning the personal income and outlays report that came out on Thursday. So personal income and outlays report, this is the one that Alan Greenspan really liked using as a basis for things, right? You can see here income is down to about revised up to 0.2% month over month. So one of the other things that we have to think about is the Fed did so much activity in such a short amount of time that trying to take annual numbers is kind of a fool's error, because the stuff that was happening 12 months ago is so much different than what's happening now. So I was talking to an economist friend of mine, and he's like, we can't use those annual numbers right now because there was so much manipulation that happened. That has to be in our rear view mirror past the 12-month moving average for us to use any of these year over year numbers. So I don't want people to be tricked. It says year over year, the core PCE is 3.5%. But when you look over month, it's 0.2%, and it's pretty much been 0.2, 0.3% for a while. So what economists are doing is they're actually looking in the future, and they're taking this number and multiplying by 12. So if you take 0.2 and multiply by 12, that's 2.4%. That's right around that Fed 2% target. So, this is great news, right? It shows that the activities that the Fed did, that they're actually taking hold. That's what the solid data is telling us. And that the core means that, again, they factored out the more volatile fuel and food that affects most of our everyday lives. But the overall underpinnings of the economy are slowing, just like the Fed wanted it to. So if you take a look at that Fed Watch tool that we take a look at, I mean, investors pretty much believe that coming up in 2 weeks when the Fed meets again, they're not going to do anything. They're going to keep watching. In fact, 6 weeks from then, At the end of January, same sentiment. 90% of investors are pretty much sure that the Fed's not going to do anything at the end of January. And then look at what happens all of a sudden. This is the first time I'm seeing this. Investors think that there's going to be a rate hike, and the majority of investors, over 50%, think there's going to be a rate hike by March. A rate drop by March, that the Fed's going to drop the rates by a quarter point in March. And so, if you take that kind of forward looking at its face value, that's, great news for all of us, both on Main Street and in investor world.
And so that's good for the market, right?
Yeah.
Especially like we're getting a ton of information, economic data, employment, housing sales, consumer confidence, GDP,
Mhm.
and the market is saying, okay, it's not good, it's not bad. Let's continue to drive the market up until we get that 4,600 level and all those sell orders kick in.
Mhm.
That seems to be what we're looking at for the next couple of weeks.
Yeah, it's most likely, and this is what I've been telling our program participants. Most likely, we're going to get a pullback, and again, it's where that pullback lands. If that pullback lands about halfway and doesn't go any further than about halfway of this prior move, somewhere probably around this 4,350 mark, it'll basically regroup and bring in more buyers, allowing us to then kick off and go towards that 4,600. The way to break through that 4,600 is you have to have as much and more buying than all the selling that's ready to happen. So right now, it's like we had all this buying to bring us right up to the edge, and people are exhausted buying. There's no more buyers right now that have enough positive sentiment to start buying enough to outweigh this. So a little pullback, a little distribution is not a bad thing, and then that could be a good kickoff. Now, the key is to follow the data, because if that distribution goes more than halfway, SIP, then it starts to be more of a kind of lackadaisical market, and then you're not going to get the momentum to get above 4,600. And if it really crashes past this initial layer here, this was at what? 4,117. Might as well just round it to 4,120. If the S&P drops below that level, then negative sentiment is our future. I'm not going to guess which one it is, but I am saying that you don't want to make any long-term plans until that next move has played out.
And as premium sellers and as options traders, it's to our advantage to take to put on positions that may that if the market stays in this kind of middle section and just grinds it out, that's good for us,
The
because
nerd term is range bound.
there we go, range bound. And
Yep.
so that's what we're looking for. That's what we're going to be going over later in the show.
Mhm.
Not sure if your pick of the week is going to be taking advantage to the downside, but we'll review a couple examples and see
Mhm.
if the setups are similar. Otherwise, if you're new to the show, or you're new to options trading, or you want to just learn a little bit more about AJ's approach and the tactics that he uses, that he's been using for quite some time now,
Mhm.
we've got a wonderful workshop. I just went ahead and threw the link into the chat. Head on over there. Check out the strategies. Check out the webinar. You can watch it today. You can watch it this weekend. It's a great way to get you involved in options trading and just learning how the community at Trading Trainer approaches the markets. We're going to take a little break here. We'll be back to talk about our topic of the week, AJ's pick of the week, and we'll do our speed round. So sit tight. We'll be back in a jiffy.
A jiffy. I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. AJ's bringing
I,
the
lo-
beard
I
back
love that
for the
funky
start.
music. I love that funky music. Bow, bow.
We're gonna have to do a remix with the Cybertruck, right?
Yeah.
Did you see the video? There was a video yesterday that came out from Tesla where it was a Cybertruck racing a Porsche, right? I think like 0 to 60, but the Cybertruck was hauling a Porsche, right? And
That's
it beat it, and so it was like kind of the rollout to, hey, we're delivering Cybertrucks.
That's a much better rollout than that time that Elon was telling everybody that it was bulletproof or whatever, and then he hit it with the bat and it all cracked up.
Yeah, and they did do a clip yesterday where they're like, "Oh, I don't know if you remember, we tried this the first time and it didn't work." But I think in a way that's their advertising is,
Yeah.
"Hey, let's get Elon up there to say or do something."
Yeah,
All
like
right.
you were telling me earlier, the interview with Elon where he said or did something about Disney pulling their money from Twitter/X.
Well,
He's
I don't wanna say what he said, but he essentially said to the CEO of Disney to go F himself twice in
yeah,
a
he made sure
CNBC
that
interview.
that was picked up correctly by the journalists. He said, "Let me emphasize."
And so it was just an interesting, I mean, what a fascinating guy. Rockets, electric cars, social media. Now we got the Neuralink stuff. Oh,
Mhm.
goodness. All right, let's get back on topic.
Yeah.
Okay, so I'm gonna go ahead and pull up our question of the day, which is vertical spreads, the good, the bad, the ugly. And
Mm.
so my question to you first is, when I hear spreads,
Mhm.
the term that I've heard the most is calendar spreads and vertical spreads.
Mhm.
Are there any other types of spreads, or are those kind of the two? And then what is a vertical spread
Mhm.
in that sense?
Yeah, there definitely is another one, and it's the one that I like the most, and it's called the diagonal spread. So it's a historical term. Back in the day, right, when you looked at the options board, when you were trading on the floor, they had these big signs that, when you had an option listed, you had the different. You had the different dates along the column headers of this like big giant display. So you had all the different expiration dates along the headers, and then you had all the strike prices along the row, headers, and then you had the prices of the individual options in the grid in before. And so what option traders would do is if they wanted to have the same expiration date but different strike prices, that would create a vertical picture, and you could circle the two options you wanted, and that would be a vertical spread. That would be the two options, and you would calculate the difference between the strikes and the difference between the going prices of those, and that's your vertical spread. If you wanted a horizontal or calendar spread, you'd go horizontal, and that would get the same strike price, different expiration dates, right? So the two options that make the spread are the same strike price, different expiration dates. So if you can imagine this big board with expiration dates along the columns and down the rows are the strike prices, this is how the option traders used to create vertical and horizontal spreads. And then, of course, diagonal is where you would have different strike prices, different expiration dates, right? And so that would create your diagonal spread. And you have two different synthetic variants, right? You have debit and you have credit spreads. They actually wind up being the same thing when you do the math, but one is just, you receive a credit and you hope that by the end of the trade, it, decays to zero. So maybe you get $1 credit up front, and then you want this trade to go to zero. Whereas the debit spread, you may decide that you buy this thing, it debits your account by $4, and you're hoping that it grows to $5 by the time it expires. It's still $1 profit, but it's just, do I get the money up front and hope that it expires worthless, or do I pay some money up front and I hope that it actually appreciates versus depreciates in value? So vertical spreads are very popular. They're probably more popular than calendar spreads or diagonal spreads. In fact, I had somebody tell me just yesterday, "Hey, I'm really good at credit spreads." And I said, "Would that be credit vertical spreads?" I kind of knew the answer already, and she said, "I think so." I said, "Same expiration date, different strike prices?" "Yeah, yeah, yeah. That's a vertical spread." So some people, they get confused on the terminology because you can have credit and debit spreads on all 3 of the variants, horizontal calendar, vertical, or diagonal. But most people are talking about vertical spreads. They're very popular. They have great reward potential, but the bad part about them is they also have pretty great risk potential. And of the courses that I've taken, um, most of the folks that teach about vertical spreads, they either don't know themselves about the whole risk component of them, or they just don't cover it very well. I've only, seen a couple of courses out there that are for just, off the shelf courses that actually explain the risk involved with a vertical spread. But if you think about it, like if I look at a chart for, um, I'll just pull up a ticker. Let's talk General Motors. That's one of my faves, right? You look at this chart on General Motors, and maybe you do a spread that's maybe you were thinking about doing a spread that's 29.30. Those are the 2 different strike prices, and you put a spread there. Just understand that the idea is that the symbol would stay below $29 and this thing would profit. But if the candidate goes above 30, you lose everything. So it's very easy. Like, for instance, anybody who was in the 29.30 vertical spread up until 3 days ago, you were doing fine. And then all of a sudden, overnight, with GM jumping above $30, you all of a sudden were wiped out. And vertical spreads are the one option strategy that I have had the most people come to me and say, "Hey, I learned how to trade vertical spreads, and I was doing really well for the first 9 months of this year. I was making like double-digit returns every month. They were coming off, without a hitch. And then something happened in month 10, and not only did I lose all the gains I made in the first 9 months, but I lost half of my initial investment. And my wife doesn't want to speak to me, and we had to mortgage the house." Right? You have no idea, Sip, if I had like a dollar bill for every time I heard that exact story because of vertical spreads. I mean, we'd all be millionaires right now because people just don't know how to evaluate risk, and they wind up overextending themselves in vertical spreads, not knowing how much risk they've taken on. And then literally in the release of a dividend, they're bankrupt. They have no more money left. And so my key thing, that's the bad and the ugly of vertical spreads. The key is make sure you size your positions appropriately, right? Make sure if you do the same analysis that I teach my program participants, which is, calculate how much risk is in the position itself. And in the case of a vertical spread, calculate 100% risk that you could lose it all. And then reverse engineer to how much of your portfolio you would like to risk in that one given trade. I usually tell my program participants to risk no more than 4% of your portfolio in any one given trade. So if you could lose the whole thing and you want to limit your loss per position to 4%, guess what? The position can only be 4% of your portfolio. You can't put in half your portfolio into a single trade. If you put half of your portfolio into a single trade and it goes against you, you're going to lose half of your portfolio. So make sure when you're doing vertical spreads, you size them appropriately for the amount of risk that you're taking on, which is your whole investment. Vertical spreads, you have to calculate that you're going to lose it all if it goes against you. So that's the key, Sip. That's what a lot of people don't do. And the reason why I personally, only do vertical spreads here and there is because if you think about it, if each position is 4%, or I actually, for my own portfolio, limit it to just 2%, in order to have my portfolio invested in vertical spreads, I have 50, 50 simultaneous positions going on simultaneously in order to have my whole portfolio working for me. 50. You know how crazy that would be to try to watch 50 positions at the same time? That's definitely not my way to trade. I got better things to do. I like the easier approach. So I'm actually all about legging into these diagonal spreads, creating a much broader range bound strategy, allowing folks, allowing less risk per position, and therefore I could put more of my portfolio into each position and therefore not have to manage so many simultaneous positions. But sometimes the vertical spread has its calling. And we'll be talking about a particular candidate that I'm using some vertical spreads on in a few minutes, but there is its place.
All right. Well, I do appreciate the explanation of the vertical versus the diagonal.
Yeah.
Because I never connected it in that way, and I think that really helps in understanding spreads and what you're actually doing in terms of one expiration date, right, versus spreading it out over a couple weeks, couple months.
Yep.
So yeah, we'll get into a couple examples, and we can dive right into it. Actually, we'll start with your pick of the week, a company that is, in terms of business, doing very, very well right now, specifically because Q4, the holiday season, everybody's spending money, everybody's running ads. And so your pick of the week this week is Meta, ticker symbol META. And your note here is that you're legging into an iron condor. Is that some sort of a bird, or where's the condor coming from?
So an iron condor is a option strategy. Let me just go ahead. I'm going to switch over my indicator. This is the free indicator, by the way, that anybody can get a hold of. You just have to get an account at our web portal, and that's free. So just sign up for an account, then you can download this indicator. And I've got it actually applied to this chart twice because you can configure this indicator in many different ways. So my one way that I've got it configured is to help me identify what's happening in the broad market. And the other way I have it is to give me buy and sell signals, end of day buy and sell signals on sideways channeling stuff. You could even use this indicator. I saw some people using it the other day for swing trading. So I've kind of just tweaked it so that it's giving me now end of day buy and sell signals for premium positions. An iron condor is a range bound strategy that's actually made of two vertical credit spreads. So we were just talking about vertical credit spreads or vertical spreads. The iron condor is specifically made up of two vertical credit spreads. And it creates a range bound strategy very similar to our premium selling strategy that we use on lower price symbols. And by legging into it, it means that I'm not putting all four option trades. I'm not putting both credit spreads on exactly the same time. I'm placing one credit spread on the top, and then when the timing's right, I place the bottom one, and then I'm constantly rolling out of the two vertical spreads throughout the lifetime of the position, right? And so we just recently placed the top credit spread on because we got this signal. We first got a signal, as you can see here, on November 21st. Now, these are end of day signals, so you can't trade them when you get them. You notice them when you come in at the end of the day after the market's closed, and you're like, oh, I should be looking at this tomorrow. And when we looked at it the next day, we did not get the trading follow through that we were looking for. So we didn't open that position. And at the end of that day, guess what? We got a signal that said, "Hey, stop looking. We know that you didn't get your fill today, but don't look anymore." Well, I'm reversing that signal. You could see that right here with this pink arrow followed by the blue arrow. So we didn't look the next day, but guess what? At the end of the next day, we're now up to November 24th. We got another signal that at the end of the day that said, "Hey, try to trade this the next day." And we did, and we got our vertical spread set. So this would be what we call a bear call vertical credit spread. So we got credit up front, and we're hoping that this thing expires worthless. And again, sized it very small, sized it so that it was 2% of our portfolio. We used a 340. I believe it was a 340, 350. Those were the two strike prices that we used. And so long as we stay below 340, this thing's going to wind up profiting by December 15th, which is the expiration of it. So now we're just waiting. And when we get our next bottom signal, we'll apply the bottom credit spread and go from there. But this is a great one for doing those credit spreads at the reversals. But just make sure you size that position just right.
And and I'm assuming this is a very liquid contract, right? Meta's probably got to be one of the more popular ones on the market.
Yeah, I'm pulling up the option chain right now. I gotta say something, and I'm not sponsored by any brokers. In fact, at Trading Trainer, we've always tried to be very much broker agnostic so that people can get our education and then use whatever broker they want. But just recently, Charles Schwab took over Thinkorswim platform from TD Ameritrade. And they didn't take it over from TD Ameritrade. They took over TD Ameritrade, and along with it came Thinkorswim. And they just recently switched the technology behind, and they broke a bunch of stuff. And they'll, if you contact the support people at Thinkorswim, they'll tell you known issues of what's going on. But a lot of the options stuff is broken, and I hope that they remedy this in the next month or two, because it's a real pain in the tuchus. But as you can see here, we're looking at the same strike price, December 15th. And you'll notice over here that we've got the, I said strike price, I meant expiration date. You got the strike prices down the center here. So when we get down to that, what did I say? 340, 350? Yes, exactly. When you look at the 340, 350, currently the 340, 350 is going for something around, you take $1.61 and you subtract out 59 cents. It's going for $1, right? Roughly $1 right now. And that's profit that you get up front. So that's $1 that you get right now. And then as this thing goes through its life to December 15, so long as the price of Meta stays below 340, that'll shrink down so that at the end of the trade, you won't have to ever pay any of that dollar back. So you get the credit up front, and then you expect for it to expire worthless. But do know that with every credit spread, in order to get that credit up front, your broker is going to say, well, what's the worst case scenario? And let's make sure while the trade is still happening that you have, it's called a margin requirement, that you have money in your account to cover the worst case scenario. In this case, if the stock price goes above 350, you'll be on the line for $9, right? So you got to collect $1 up front, but if it goes above 350, you're going to have to give that dollar back, and you're going to have to take out of your pocket $9, right? And so even though people think credit spreads are like free money, don't forget your broker is going to look at your bank account, and for every option share that you do, they're going to put a hold on $900. And until you close this position and say, no, it's all closed, you can release that funds, they're going to lock that money up. It's called a margin requirement. So the initial investment that you want to calculate into this trade is that $900 per contract, right? So $900 of risk, but if the trade goes your way, you get $100. So that's actually pretty good. If you invest $900 and at the end of 2 weeks, because in December 15th is about 2 weeks from now, at the end of 2 weeks, you get $100 of profit. I mean, that's more than 10%. That's more like 12%. That's not bad.
And as always, we would recommend that you have your risk parameters in order, that you're not risking more than you're able to contribute. And so that's AJ's pick of the week, Meta. It's a name we haven't looked at in a while, but one that's constantly in the news. You're going to run the risk reward real quick.
You need to have a $45,000 portfolio to do one contract, right? If you're keeping it at 2%, if you're going to keep your risk at 4%, which is really the max I tell my program participants, again, $900, $900 divided by 0.04, $22,500. If your portfolio is smaller than $22,500, you're not doing any credit spreads on Meta. And if you are doing credit spreads on Meta, realize that you have overextended yourself and you're putting yourself in a position where you could wipe out your portfolio very easily.
And that's AJ's pick of the week. One name of many that we continue to look at throughout the week, that the group, all the members at Trading Trainer, review every Thursday, throwing out some new names. But now it's time to get into some of the names from, members, participants throughout the week. And we'll start with one that you already covered a little bit earlier, and that's one that I think we've discussed it on the show about 4 or 5 times in a row now. This is LaRue from Ann Arbor, Michigan, interested in General Motors, probably because I don't know if a LaRue is a he or a her, but they are in the GM world up there. So looks like we got a nice little pop the last couple of days.
Yeah. So I wish I knew about this pop. This is, I think... So I'm a big fan of General Motors as a company, although I don't own any of their cars. But I think that they're positioned well. They've got a lot of government subsidies going into them for researching EVs. They've just finished negotiating, and they have a nice contract with the United Auto Workers. And they were sideways channeling for quite some time. If we go back in time, you can see that this was a beautiful pattern until all the shenanigans with the UAW came forward. This was a beautiful pattern for us to sell premium against. Well, I think with this pop-up from the dividend coming, and with GM now going to go back to not being a mainstream name in the news, we have to let it play out, LaRue, but I wouldn't be surprised. And if you picked up, like me, if you picked up some GM stock because you just want it in the long term in your portfolio at the low price that we've been seeing over the past month or so, here's to you, right? You just got a nice little uptick in cost basis. As far as getting into GM now, I would wait. I'm still, just like I gave some advice about 2 weeks ago, I would wait for GM to mature into its new pattern. And whenever I say the word mature, there's actually some quantitative definition to a stock price maturing. And that is, you have a minimum of 2 tests of support and a minimum of 2 tests of resistance. So right now with this gap up, there's really no tests of support or resistance. So we got to watch GM, and until it becomes mature, any trade that we might do on it would be just a speculative trade at most. So let's let this thing play out. Let's let it tell us. Let's let the investors who are moving price tell us where the floor is and where the ceiling is. Once that's been established, we can do some trade plans on it and we can make this part of our portfolio again. But again, for those people that just had a fancy for GM and you bought it while it was at its low around 28, 27 bucks, good for you. Good for you.
Yeah, and the indicator did give a nice positive signal if anybody's using that as a
It did.
identifier for positions. Maybe not as much of the items that you would want checked off in order to put a trade on, but it's definitely a good sign that the indicator was early into that move. So
Especially after a double bottom. So for you trend traders, I know you pay a lot of attention to double bottoms. We can throw our candles on. I know that there was a lot of candle pattern confirmation. And then, yeah, my indicator kicked in and the follow through came in. I believe the follow through came in on November 20th. And then this dividend was released in POW. You just instantly made about 8% on your stock position. So that's pretty cool.
yeah, we'll probably keep an eye on this one the next couple of weeks. Won't be the last time we review it. Moving on to our next name, another company that we've talked about a handful of times recently and throughout the show. This is Jason in Tacoma, Washington, interested in Zoom, ticker symbol ZM.
Well, now Zoom is totally so. There's a statistical. You'll notice here on my chart, I have outlined what I call the 40% line. So support and resistance I identified between 64.50 and 73.75, and that was because there were multiple, more than two, sometimes three, sometimes four tests of these levels. That was support and resistance. And then you'll notice that I have my drawing software calculate what 40% outside of the channel in both directions would be. And that's because statistically, if a sideways channeling symbol moves more than 40% out of its channel, the probability that it will actually return, and not only return, but cross that channel, shrinks considerably. And so you can see here, Zoom bounced out by more than 40%. It's actually closer to 50% of its channel. And so if we're following our black and white rules, we kind of said, okay, it's time to stop following Zoom until it, matures into a new price pattern. Well, Zoom is just proving to us that there's always that small percentage chance that, it can do what you don't expect it to do. Zoom has come back into the channel. It's already past the halfway mark and it's heading up to resistance. And so guess what? It's back in play for me. I didn't jump in on any of these indicators down here. I'd like to see where it lands. I'd like to see where this thing lands. Let me go ahead and take my drawing tool and I'm going to extend it to the right. You know what I would do? I would totally take this weekend and I would redo your plan. I would update your trade plan on this and plan on it reversing somewhere around this $74 mark. When it does reverse, be prepared to either short shares of Zoom in lots of 100, or if you don't want to do any shorting, because that is a margin trade, if you'd rather do a cash trade, you could go long some deep in the money, far out in time put options. They would behave just like that shorted stock, only opposite. So a shorted stock would go down $1. This back month substitute option would go up $1. So that's why you can turn that margin trade into a cash trade. I would be ready to do that, and then I would be trading the down move on Zoom that follows after a reversal. So that's my suggestion on Zoom. In other words, in summary, spend the weekend planning out your trade and then watch for that next top reversal signal.
Yeah, definitely getting some movement there. And I think your analysis is spot on. So thank you for that, Jason. Zoom. Moving on to our third and final name in the speed round. This is Patel from San Jose, California, interested in NVIDIA, ticker
Ah,
symbol NVDA, the AI king.
yeah,
Everything AI. Whenever you hear AI on the news, it's NVIDIA's somewhere in the discussion.
yeah. Their chips are to die for, right? Not just AI king, but gaming king and crypto king. That their chips power the mining servers. Those graphics chips are just so elegant. They do a lot more than graphics. They have the language models now. That's the hot news, like you just said. Okay, so Nvidia's in that sideways choppy channel, but look, it's up at the higher price. You're not going to be able to, unless your portfolio is in the, you know, millions to tens of millions. You're not going to be able to set up the premium selling on this that we would do if we had a stock that was in the $10 to $20 range. So what I would think here is back to kind of the topic of the day. I would look for legging into those iron condors. I would do vertical credit spreads. We did get a signal and a confirmation back on November 22nd. So I'm not sure if you've already missed this top reversal signal. I think you might have. So I'd be very careful about placing a bear vertical spread right now. I think you're about a week and a half late. But I would look for the opportunity to place the bull vertical spread. So as this guy comes back down somewhere around here, which has been tested 3 times now, so we know that there's heavy resistance down at 410. When it comes down to that level of support, I'd be ready to place on a bull vertical spread. If you're going to do credit spreads, it would be a bull put vertical credit spread. If you're going to do debit spreads, then it would be a bull call vertical debit spread. Whichever one, they're synthetically equivalent. It doesn't really matter which one you use. But I'd be getting ready for that particular trade at the next bottom.
Awesome. Thank you, Patel. AJ, I do have a question on the more expensive stocks, right? Because I know in the past that like Amazon was one of them. At what point do they start to consider some sort of a split so that the lower investors can start to come in? What are your thoughts on that?
Well, that's a great question. And that really comes down again to perception and whether a company knows its investors, right? So Apple has such, and Tesla is another example of this. They have such a good following, right? There are just some die-hard Apple users. There are some die-hard Tesla users. And so it makes sense that the company should try to position the stock price to make those fans, those fanatics around that brand investors, right? They would be great investors. And so you'll notice that Apple tries to keep its stock price. At one point, Apple had raced up to like $1,000 a share, and they did a 10-for-1 split to bring the stock price down to the $100 range, so that its fanatics could then be supporters, right? It just makes sense to have your fanatics. If you're kind of a boring stock, um, you know, like for instance, look at the price of Berkshire Hathaway. They're specifically wanting to make their share price expensive because they want to have only, rich people involved. They want you, it's basically a negative deterrent. So they only have the right composition of investor, somebody who's got some money, because they think Berkshire Hathaway's managers believe that, if you have enough money to buy their stock ticker at that really high price, that you would be a worthy investor in the pool of people who own that company. So it really is a marketing decision as to whether you do that. Amazon is another one. They've done some reverse split, but interestingly enough, Amazon doesn't have the fans that like an Apple or a Tesla does, right? I don't know anybody who runs up and down the street with their Amazon Fire Stick saying, "Yeah, this is the best thing since sliced bread," or if anything, Amazon gets a little bit of a negative press, and they're just one of those companies that we've grown to just know that it's just always around. But and we love that we can get things so quickly from them, but at the same time they've had such negative press about how they treat their workers and stuff like that, that they don't have the fans. And I think they did a reverse split and they found that they didn't get the results they thought, because I think they made a business decision that they expected their fans to jump in as investors, and that just didn't happen. So, it comes down to really the perception, and it's a strategic marketing decision.
Yeah, and obviously with a cheaper stock, you get more options traders.
Yeah.
So
Yeah.
I would imagine Nvidia could have a community like that. So we'll keep an eye on it. But getting up there to $500 a share, you definitely got to have the portfolio to take on some of those
And
positions.
just look at the earnings that they give. Oh my goodness, $4.02 a share. That's not bad. That's really
The
not
dividend,
bad.
you mean, right?
No, the
Or is that
earnings. They're actually, the
Oh.
dividend is kind of pathetic, right? They're giving 4 cents back per share.
brutal.
They're not. I bet you if you look closely at their quarterlies, I bet you they do a lot of stock buybacks. There's a lot of funny money games that you can do as an accountant for one of these big companies. And one of them is playing with the stock price through the reverse split and split. But there's also stock buybacks. There's also dividends. There's a couple of different ways you can play around with the accounting of a business to make it look good to investors.
All right. Well, that was NVIDIA. Thank you, Patel. AJ, thank you. It looks like we're getting close to the end of our show today. If you've enjoyed the broadcast, if you're new to the show, new to the channel, please follow along. Hit that like, hit that follow, hit that subscribe button.
Yeah.
We do our best to provide you with high quality weekly content, to give you some insights into some positions, some names that the trading trainer community is looking at. And as always, if you have questions, feel free to throw them in the chat, throw them in the DM. We love to get back to you. Love to bring up some of these topics onto the show and provide you with some answers. With that, AJ, the first day of the month of December, heading into next week, anything in particular that we should be keeping an eye on other than just that potential sell-off that looks to be maybe taking place? Although I am seeing the market up 185 now since we started the show, so it's not slowing down.
Yeah, no, it just shows how resilient, there's just this optimism, and it's been playing through. It's amazing. And again, it's a divergence, the optimism that's in investors versus, you hear on the street how disappointed people are, but it just doesn't make sense. It doesn't make sense. So my suggestion to everybody is rules-based. Make sure you calculate your risk correctly and do things on data. Don't be trusting what you hear on, especially from the talking heads on the different programs. You got to do things that's data driven, rules based, and make sure you account for risk.
All right. And with that, we're going to go ahead and close things out. AJ, thank you for once again another wonderful show. Everyone, thank you for tuning in. We'll catch everybody next week. Thank you, guys.
Bye. Thank you.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.